All right, welcome back to the channel. We got a quick stock market update for you. This past week we had the Fed meeting, and in that Fed meeting they decided to keep interest rates steady, not cut, not raise. And we're seeing the market this past week be a little red, take a little bit of a dip down. It looks a little sketchy. It's guilty until proven innocent, but we'll have to see how it goes. Long-term investing doesn't matter. But it is interesting to see the market's reaction to what the Fed had to say. They've been saying the same thing all year long. They're data dependent. They don't want to cut too quick because if they do, that may bring back inflation. They want to really make sure they got inflation under control before they start cutting rates, because they can handle a weaker economy better than they can handle high inflation. And recently we're starting to see oil come back up. Food prices are super high. A lot of things aren't going up at the same rate like we've talked about. They're just flattening out. Some things are starting to reaccelerate, but nothing's coming down. Your car insurance isn't coming down. Your home insurance isn't coming down. The price of homes isn't coming down. Maybe a pair of socks are coming down, or shoes, or a dishwasher. There's some goods that are coming down, but that again, they're just normalizing. You know, a dishwasher was $200, now it's $500, and it's going back to $400. It's still double what it was pre-COVID. So anyways, you know my inflation thoughts. We've talked about it in other videos, and it does look like inflation will be higher for longer. That's why interest rates will be higher for longer. So, with that being said, the market has to react to the Fed being higher for longer. Because when we look at the dot plot here, the dot plot, this is the Fed, the people at the Fed, their projections for where they see interest rates going in the future. And the market and the Fed were somewhat aligned when it comes to these expectations. The market has just been anticipating quicker rate cuts. So rate cuts coming at the beginning of next year. The Fed is telling us, no, we're going to start cutting maybe at the end of next year, but we're still data dependent. We have to see how inflation, unemployment, GDP, all the data comes in. Because again, they don't want to cut too early. They'd rather there be a little bit of pain in the economy, because that'll bring inflation down. But if inflation reaccelerates, there's only so much they can do with interest rates. So that is what we're seeing here. This was a change in the dot plot. Again, the Fed was projecting rate cuts a little sooner, and they've pushed those out. So higher interest rates for longer affects companies that have to borrow a lot of cash, companies that are not profitable, because if there's no profits, they have to rely on borrowing to pay their employees, to pay their energy bills, whatever. And with higher borrowing costs, that's going to hurt them even more. So that's where the market's saying, well, if you're an unprofitable company, I'm going to sell your stock. I'm not going to hold you right now until we have lower interest rate environment, or if your business can get profitable or improve. So the market is digesting that. We also have seasonality. So this is a chart here showing S&P average returns by month for a long time here. And this is not super up to date because it stops at 2015, but it's a large chunk of data, and it does show that August and September on average are red, and then we have a strong end of the quarter. So there's an old saying, and all this stuff, it's interesting. I don't base my investing off of this. I take what the market gives me, and I buy good companies at wonderful prices. That's a Buffett quote. So there's an old saying, sell in May and go away. So people typically say, okay, I'm going to sell some stock in May, and I'll come back in October or November when the market is bottomed out. Anyways, not going to get too much into that, but there is a little bit of seasonality to the stock market. And when we look at the heat map again, we got the 1 week, pretty red, 1 month, kind of flat. And then when we go to 1 year, boom, Christmas, a lot of green. So this has been a great year, especially for tech. And again, it's a great year now because we were in the dumps last year. Last year was a terrible year, and a lot of these technology stocks just got oversold, and then money flooded back into them, shooting them up. So that is a little snapshot of this past week. The last thing I want to talk about here is this is the chart of the S&P 500, and these are just my little notes based on where we've come from and where we could be going. So way back here, we've got the COVID crash, the recovery from that. And towards the top here, as we started to curl down, that is the bubble bursting. So that's your Pelotons, all kinds of different stocks that, were pretty bubbly. But also at the start of this curl down, this is when the Fed started raising interest rates. So again, assets had to adjust from being at free money to higher costs of money. So that was the market re-rating itself, getting rid of some of the froth, some of the bubble stuff. And then we bottomed out here, ironically, right around the introduction of ChatGPT to the public. And this kind of accelerated, AI. We had inflation starting to come down. We had soft landing talk saying, oh, the Fed, they're going to create a soft landing, meaning they went from zero rates to high rates without crashing the economy. And now we are reaching the point where we're starting to curl down. We're still in a clear uptrend with this green line. So that's good because a trend, once established, momentum will continue moving it forward. It takes more momentum to reverse the trend than to keep it going forward. So I'm not expecting Armageddon or the end of the world, but it wouldn't surprise me if the market were to take a little bit more of a dip the rest of this month, maybe the first half of September or October, and then we have a strong end of the year push. And then who knows after that? I have no crystal ball. That'll be up to earnings, GDP, inflation, geopolitical stuff, all kinds of stuff. I have no clue. So that is kind of a little history of where we've come from. And then let's zoom in a little bit to where we are today. The things I'm really looking at is we've got the higher for longer talk, which, it's not the end of the world. I think it's the right thing for the Fed to do. We don't need them cutting rates and stimulating and free money popping up all over the place. We don't need that again because that could reignite inflation. And we are seeing, like I said, inflation, some things are being very sticky. So they should be a little bit on the restrictive side. The problem is, as we've talked about, interest rates have nothing to do with oil. Interest rates have nothing to do with auto union strikes and labor. Everybody wants higher wages. Higher wages means more money to be spent in the economy, which means the price for goods and services will increase. That is inflation. So anyways, we got higher for longer and consumer recession. Those are the two things I'm going to be looking at. Consumer recession, we've got a lot of credit card debt out there, and we're starting to see cracks in the consumer. And when I say the consumer, I'm not talking the Louis Vuitton consumers. I'm talking about the Dollar General consumers. Those are the ones that are really getting killed here with higher inflation. And we have still seen companies laying people off. So we just got to see how that works out. How does the consumer hold up with high prices, high interest rates, high housing, high car prices, all those things? Where's this money coming from? Because there's no more stimulus. There is jobs out there, but as you're seeing, the jobs aren't paying enough money because everyone's striking and asking for more cash. So we just have to see how these things resolve themselves, and will the consumer adjust their habits? Do they skip an iPhone cycle? Do they not go on that trip to Europe? Do they not go to the Taylor Swift concert? All those things. And if the consumer starts to push back, that's going to be bad for stock earnings, and we'll just, we'll see from there. So those are the two things I'm looking at. In the short term, like I said, wouldn't be surprised if there's some more pain in the market. Nothing crazy, but I think I'm going to be taking advantage of the seasonality, and I think right now is not a bad time to continue doing your dollar cost average and also looking around and saying, all right, what is getting whacked? What is getting whacked just because of what the Fed said? What is still a great business, has growing earnings, good balance sheet, great management? Let's go buy stuff on a discount. So that's what I'm looking at. I will be doing some buying these next few weeks. I'll let you know what I'm buying, when I'm buying. So that's what I got for you guys today. Until then, enjoy the weekend, and I will talk to you all soon. Peace out.